welcome everybody. Thank you so much for joining us on this Tuesday afternoon. My name is Laura Nieves and I am proudly responsible for Astor Realty Capital's investor relations and operations. So today we are very, very excited to introduce you to our new investment opportunity. It is a Caesars Entertainment, the first non-gaming 265 room, 5-star lifestyle hotel in Scottsdale, Arizona. We're very, very excited about this opportunity. We are sure that you will be as well. So we're excited to present it to you. So before we get started this afternoon, I will say a couple of words about our company, Astor Realty Capital. As a lot of you are aware, but I actually do see quite a lot of new potential investors today, which is exciting. So welcome. And our firm, Astor Realty Capital, we're a private equity firm with a portfolio spanning in 12 US submarkets, 7 states. We have 3.43 million square feet and participation in $1.96 billion of real estate since inception. We're headquartered in New York. We have operations in Miami and Phoenix, Arizona. The Astor team, along with our co-founders, Joe and Michael, who are here with us today, we consist of experienced real estate professionals, and we're fully integrated with our sister company, Burko and Associates. During the Zoom today, we will have the opportunity for some questions, so please drop them in the chat. We will do our best to answer them. If for whatever reason we're unable to answer one of your questions, we'll reach out after to address them personally. So on that note, I would like to introduce you to our presenter and host today, Joe Burko. Joe is the co-founder of Astor Realty Capital. Over Joe's 25-year career, he has structured, raised, syndicated, and sold over $4 billion of commercial real estate. So on that note, I will pass you over to Joe.
Wonderful. Thank you very much, Laura. Hello, everyone. Hello. Good to see many of you here. Marika, if you can put yourself on mute, that will be also great. Great to be here this afternoon, streaming to you from New York City. It's been a good month and a half since we were there last. It's great to see that the sun is out and the masks are down. So that's always a very good sign. Let's just start with the presentation. Laura, if you can please put it up. Wonderful. So we are very excited to take part in this asset, the Caesar Republic in Scottsdale, Arizona. Like Laura mentioned, this is a 265-key non-gaming, the first of its kind, non-gaming Caesar in the United States, in the world. It is a 5-star lifestyle hotel with a very heavy food and beverage, which means cool restaurants, great locations. We'll talk about all that stuff in a moment. Essentially, we are participating in the land lease acquisition of a wonderful parcel of land as directly next to a phenomenal 2 million square feet retail, very high-end retail that's located in, I would call it, the heart of Scottsdale. We're looking to construct 247,000 square feet with, as I mentioned, 265 rooms, 7,000 square feet of high-end conference center and business centers that is able to fit as many as 500 individuals. We'll have a very, very nice rooftop pool and restaurant with fantastic views. One of the landmarks in the area called Camelback. As well, we're going to have a couple of restaurants that are celebrated by highly recognized chefs. Total project cost will be $107.5 million, out of which we'll use $76.2 million of debt, and the rest will be $31.3 million of equity. We anticipate that once completed and stabilized, the asset will sell for $165 million. Astor and its partner Migdalor are slated to take 14.7% of the ownership in the asset. The majority will be remains in the hands of the developer, our partner, Rick Huffman and his team. We're putting a large vest of the capital, and the rest will be other LP participants in this project. We're underwriting the deal in a realistic and somewhat conservative approach to generate for you, the investor, after fees, after promotes, after all that, about 25% a year. Project duration will be 42 to 48 months, and we anticipate to close sometime around the month of May. So what's unique about Caesar Republic is a number of different things. I would point out to the partnership that we've created with HCW, Rick Hoffman and his team. Their experience level will be discussed more, but essentially, as I mentioned, we're looking to team up with a very, very seasoned group and to present, something that's quite different, very, very unique in an area that is considered a white glove location that it is a very large draw because of the immediate surrounding and of course the retail that I've mentioned. I'll skip the word to word verbatim part of the business plan because I sort of like depicted it at this point. But of course the presentation will be sent over to you, and I urge you to take some time and review it. Acquisition was actually the land lease was acquired and commenced at this point nearly 3 years ago in 2019. Sometime in the middle of 2019, the land lease was signed and work has commenced to prepare the ground, go through the permits, lots of planning phases. The most important also is signing up Caesar Republic. There was a big search to look for the right type of brand that will be unique to the location, that will draw and will be something that is quite outstanding. A number of conversations with a number of hotels such as Hilton and Marriott and very many other brands which were competing to become the flag in that place have been going on, and then eventually an agreement was reached with Caesar. Caesar itself, it's a large organization, public company operating with a market cap of about $14.7 billion. That's been operating, you can trace it back. The ownership of Caesar and the Caesar brand can be traced back for over 90 plus years. It's been in the hands of some of the largest hoteliers, and it started with the Hera family. Those who are familiar with Vegas and the Harrah's Hotel that are elsewhere as well. That's how Caesar started the brand itself and gained momentum as one of the leading gaming hotels in the United States and the world. So we're happy to do and to take part in this participation. We're in the phase of wrapping up our operating agreement, and we've signed a letter of understanding. Our attorneys are fast at working, and we anticipate in the next few weeks to be in a position to close this deal together and be part of this project. At this stage, we have a bank that's in place. The groundwork has commenced, as I mentioned, and we're stepping into a project that has a fully entitled project with a loan in place, with a mezzanine in place. We're looking to start the construction, complete the construction sometimes in the next 24 months, give or take, allow the hotel to start stabilizing, and then anticipating to sell the asset sometimes between the middle of the third year towards the end of the third year. The reasons are kind of like focusing on some of the reasons we liked this asset is, first of all, we see a path to offer you, the investor, an annual return of around 25% per year. We even feel that there's a chance to give you, the investor, higher returns. We'll talk about this in a moment in our underwriting, but we are considering the fact that this is, it's a great brand, the publicly traded companies, that is the reservation system in the flag. I think it's a really great thing. The location, as I mentioned, is prime, really prime. Fashion Mall, Fashion Square is, one of the most profitable malls in the United States, and it has 240 high-end specialized stores, 2 million square feet. Quite a unique and quite a draw in itself. The mall is adjacent. In fact, it used to be part of the land itself used to be part of the mall, was slated for expansion. They've decided to bring a hoteliers, and this is how our partners who are highly experienced with over 45 years of experience, or built over 2,500 hotel rooms and well over 6,000 apartments in their career, are stepping into something fully seasoned. And again, we're very excited about that. So a little bit about the asset, if I may. It is it's operates, with a number of luxury suites from the 265 keys. Is going to be suites that are dedicated to various events and wedding suites and the king suites, all with phenomenal views towards Camelback. It's a luxury brand, as I mentioned, quite a unique one in its kind, and the food and beverage and the entire experience that the hotel is offering, it's quite different. I hope I'm not murdering Gaida's name, but Gaida De Laurentiis has signed up as the restaurateur that will be running the food and beverage, the main food and beverage hall. Those who are in the States might be familiar with her work. She's features in numerous publications, and she runs her own show. She's quite a character and very big draw. So excited about that. As I mentioned, there's going to be it's a lifestyle hotel. So the concept of 7, which is a rooftop pool and lounge, with restaurants, is also a very interesting and a very like a lively situation that we're very happy to have in this project. Contemporary conference centers, meeting room 7,000 square feet, and a main ballroom that we can draw for large conferences of up to 500 people is also a very important concept. There's been a lot that's written about in the media about Caesar. We're not going to go through here, but in your presentation, you can click through each and every one of those. The city has been excited to welcome Caesar. The adjacent large retail center is very complementary to it. So we believe it's going to be an extremely well received and very well operated hotel. Let's talk about budget and capital stack. As I mentioned earlier, we're taking senior debt, $56 million that's in place. We're also going to complement it with $20 million of preferred equity or unsecured mezzanine loan. Our participation, Astor's equity, will be just shy of $5 million. Sources and uses, we have $107 million that will be placed to work. The capital will be used in order to build the hotel, $77 million of hard cost, around $3.2 million contingencies, to our soft cost, food and beverage, developer's fee that's given to HCW, financing costs. Everything will be spent according to the very same schedule. And you can see here in our diagram, Astor equity will be 14.7%. As far as our projected pro forma, 265 keys, our average daily rate is anticipated at $349 per night, and occupancy is anticipated at fully stabilization at 74%, presenting us with a RevPAR, or revenue per available room night, at $258. So we're looking at about $25 million from room revenue. Food and beverage will be around $17 million. And then we have other departmental income for a total of $43.5 million in gross income coming into the hotel. We're looking into total departmental expenses of around $18 million, administrative costs, technology, all the other things to run the hotel, royalty fees. Caesars is making about $1.6 million a year. Maintenance repair, we're running at $7.25 million. and non-operational such as non-operational such as ground lease, management fee, parking expenses, taxes, and insurance at another 2.875. We're looking at a potential EBITDA or NOI at around $15.3 million. There's also replacement reserve to the different areas. Running expenses are at about 1.3 million. And so we're anticipating a $14 million annual net operating income, or as better referred to in the hotel business, EBITDA. In terms of exits, we're anticipating $165 million in sales once the hotel is stabilized. We're looking into payment of the first debt position, repayment of the preferred, and those of you who have been paying attention, we're taking $20 million of preferred equity and returning back $23 million. The reason for it is that we have a certain portion of the preferred return. The second position loan is accruing some interest, some of it is reserved, and we're paying it as we go along. And there's another portion that we pay at the back end for a total of $23 million. We're going to be left with about $84 million in gross proceeds. We'll also anticipate about $9.4 million of cash from operations. Okay, so for the holding period, we expected to, during the holding period and the operation, a certain portion of it will be available to us, the investors, all the investors. We're looking at that point to repay the equity, which is just shy of $30.9 million, and anticipating a $62.6 million in profits. For our investors, for those of you who are not familiar with our structure, we are an institutionally backed private equity fund with a partnership that was created, now going on its fifth year. So what does it mean? Essentially, when we go into every transaction, we have a partnership with a group that we supply us with the majority of capital that we need. In fact, if we needed the entire amount, that will be supplied as well. Astor was essentially created in order to allow our friends, our family, ourselves, we put money into every deal, just like everybody else, take the exact same risk, just like everybody else. We started this because we wanted to have people that are close to us, the ability to participate in high quality deals with high quality managers. And so we always keep a portion, sometimes a larger portion, sometimes a smaller portion, to our friends and family to participate. And we allow them to participate with smaller items, smaller checks, in this case, $50,000. I do want to say that if you want to participate and this is your first time, you can cut a smaller check as well. And of course, many of our investors never are satisfied with one unit of investment. And so they invest in multiple units. So in other words, we're less concerned about the amount. What we find lately is that we're oversubscribed, sometimes double oversubscribed. So if we need $750,000 to bridge the difference that we're taking from our institutional group, we find that the demand is so strong that there's a requirement to put an additional $1.5 million. Obviously, we only have what we have to invest. So we're less concerned. I'm more interested in having the inclusivity of a large group of investors. Typically, in each and every one of our deals, we're stopping around 10 to 12 investors per transactions. So as I mentioned, in $50,000 in this particular case, $50,000 investment over the course of 48 months will generate the investor an additional $53,000, sorry, throwing millions left and right, $53,000 for a total of $103,000, generating 25.4% and a total return of 101.7. So it's a little bit over double over the course of 4 years. On the left side, the assumptions that we're taking, $745,000 is the total investment amount. We're anticipating $941,000 in gross returns. Our structure is the first 8% we offer to our investors. Any dollars over 8% on an annualized basis, Astor participates to the tune of 75-25, 75 to the investors and 25 to Astor for the work that Astor does. So we remove from the $981,000, we remove the first layer of 8%. So that amount over the course of 4 years, in this case, in this example, will be removed $238,000, which will be the untouchable amount. Okay, that's called the preferred return. So first 8% is the minimum hurdle. The remainder will be $743,000 left for promote. 25% will be Astor's fee, as you can see it here, $185,000, and the distributions between the amount of preferred and the amount left after promote will be $796,000. So we're looking into a total return of $1.5 million in the investment, and again, 25.4% annual return. As far as the stress test, if you look at the right-hand side, we're given an idea of essentially what sort of returns we're anticipating, providing at the moment on sale, what sort of a market we're going to be facing. And since nobody knows what sort of a market, we can only predict, we can only anticipate. You have a good amount of examples. If the hotel sells for a higher amount, which is what 7 cap represents, we're looking at 36% return to our investors. Again, that's an annual return net to you. And we should all be making that, God willing. And if the hotel will do not so hot, that will represent the 9% cap rate. The investors will be slated to make around 22.1%. We're somewhere on our analysis, we're somewhere in the cooler portion. When I say cooler, I mean from the point of cooler degrees. So we're looking at an 8.5% on a cap rate that will generate for us 25.4. Of course, it could be much better to all of us. We could be making a lot better. As a side point, a lot of these hotels are trading around a 6.5, 7. Okay, so it could be quite a phenomenal return to all of us. I'm taking into account that because it's a land lease, we're going to get hit by about maybe 75, 50, maybe 100 basis points. And this is why we're not assuming 6.5 or 7.5. We're taking additional precautionary measure and managing expectations. Still, with that in mind, I think we're looking into some pretty solid returns here. The competitor set essentially are 7 different hotels that are in the same class that we've analyzed. 5-star hotel, lifestyle hotel in the Scottsdale and the immediate Arizona vicinity that we looked at to study their occupancy level, study their average daily rates, study their revenue per available room, what are the demands. All this information is available here. In fact, we have a full report that we've commissioned from Spiff Travel, or also known as Star, that's available to you. But the information that we are collecting, all this potential revenues and the supply and everything that's coming up, again, it's part of your overall due diligence package that you'll have access to once you'll express interest in the asset. In terms of where things are selling in Phoenix, as you can see on the right side, the resort style essentially we're somewhere in what would be considered between city center hotels. So we're running between 6.5, pointed out by the green arrow, we're running between 6.5 and an 8. Having said that, we're also a lifestyle, so there's very good assumptions that we should be able to sell for the price point that we've mentioned, and potentially for a lot higher. On the left side, you'll see some of the arrows pointing to hotels that are in our competitive set, such as the Waldorf Astoria in Arizona, such as the JW Marriott in Phoenix, and such as the Sanctuary on Camelback, which is the closest one to us. And the price point that they're achieving for their hotels is quite through the roof. A little bit about our partner, which I think is a big part of this story here. Again, it's a 45-year company started by individuals that in the construction business. Rick Halfand and his teammates have taken a small company, small family company, and just multiplied. They're operating in many states. They have over 600 employees. As I mentioned, they manage over 500,000 square feet of retail. They've built over 6,000 units, multiple projects, and well over 2,700 hotel rooms. They have an in-house management company for the hotel that they manage. They have a staff of over 400 employees, and they've gotten many awards over the years. It's just a pleasure to work with these individuals. Nobody's here spring chicken. This is also a second generation of individuals that have been working with them. I can say one thing about Richard. His energy level, I call him kind of like, the 60-year-old running on 16. I don't think I've ever seen anybody who moves around between one project to the next, visits all the projects, shakes hands, cut deals, buy land, and continues doing the same thing the next morning, always with a smile. Just a pleasure of an individual. So is the rest of the team. They're just wonderful individuals, actually very, very inspiring to meet with them in their offices and on the sites and so on. They're just a pleasure. We're not going to go into this too much, but we wanted to bring you some of the hotels that they currently have under management. As I mentioned, they built over 2,700 rooms right now under their portfolio. They own about 1,900 rooms in a variety of hotels in a variety of states, such as Missouri and Indiana and Kansas, Arizona, of course, which is their home base, and many others. There's also a lot of good active pipeline. One of these deals we're looking into as well, other than the Caesar, which is in their pipeline. So these are the three deals that they're looking to build next, and we're looking to participate in future deals with them on the multifamily side as well, also in Arizona. A little bit about the location. As I mentioned, this is sort of like the heart of Scottsdale, super affluent location. Arizona itself, you can see Fashion Square. This is really adjacent, abutting Fashion Square. In fact, we're enjoying some of the parking. We'll have about 300 parking spots that will be taken away from Fashion Square for the benefit of this hotel. Fashion Square is just an attraction in itself, and it's just a phenomenal place. The way it's built, the experience of walking through the restaurants, food and beverage. As I mentioned, over 2 million square feet of a mall, 240 stores, many of which are specialized and very, very high end. Many of the high end brands that you're familiar with. There's a lot that can be said about Arizona, and specifically about Phoenix, and even more specifically about Scottsdale. There's been a lot of displacement, a lot of companies that we've been tracking for the last couple of years that have been moving down to Arizona for ease, for a better tech structure, for a better quality of living. And the trend, it keeps on persisting. We've had the same conversations about Miami specifically, Florida in general, and this story is no different. My partner Michael lives a short drive away from there. I moved there about 6 years ago. As I mentioned, we've been tracking Arizona, we've been tracking Texas. Last 30 days or so, we signed our first deal in Texas, and this is, we're very excited to enter into Arizona, and we're entering with quite a splash. This is not something on the sidelines. This is sort of like heart center, where things truly makes a difference. Tourism is about 45 million tourists a year that are coming or passing through Arizona. It's a very massive industry. In comparison, New York City is generating about 64 million tourists a year, and it's sort of like top line. when it comes to tourism. So Arizona doesn't fall far from it. So there's quite a demand for tourism, for the hospitality business, and for everything else that we're doing in this project. That brings us to the end of our presentation. I'll say a few words about Astor Realty Capital, who we are, and what we're out to do. So Astor Realty Capital is, as mentioned before, we're private equity. We're collectively 60 years plus of experience in the real estate arena. I've been around for about 25, 26 years. My partner, Michael, has been in the real estate business for about 35 years. And we've launched Astor Realty Capital 7.5 years ago after a long career on both of us, mainly as advisors to public companies, private individuals, mainly as commercial real estate advisors, selling properties, helping the companies acquire assets and raising capital, both public and private companies. Astor essentially came as sort of like a changing of hats. As investors, we always placed our money into real estate, but I also felt that it's maybe time, after 20 some odd years of doing what I'm doing, maybe it's time to change the concept of being an advisor and actually put my money where my mouth is. And those that found it to be interesting and compelling should be able to join. Small ticket items, small checks, however, they should be able to join. And so we started with the concept of preservation of capital comes first. It's good to make money. It's good to make a lot of money. Profits are great. But if we don't know how to preserve capital, then there's no reason for us to be in the deal. Ongoing asset management is one of the areas that I think is important to our organization. As opposed to an investor coming in and putting money with a developer directly, going through our concept essentially gives you two main areas of comfort. The first one is collective bargaining, because we show up with a check of $5 million. I wish we had more. I wish we had more room to participate with Rick and his group. But when we show up, we are negotiated from the standpoint of $5 million. So you're 100,000, 50,000, 25,000, 300,000. Essentially gets better treatment. On top of it, we have created a mechanism of takeover events, of control rights in the event that our sponsor, our developer, who manages really the day-to-day when we manage the month-to-month, if they do something that they shouldn't, if money goes from one side to the next, any sort of bad act, we have the right to step in and cure it. We have the right to remove our developing partner and replace him by somebody else. So those two things, you have a group here that is sort of like making sure that your capital is secured, not just from the level of choosing the right developer, but also from the level of making sure that the developer that you chose does the right thing or else. So asset management is extremely important. We are generating above average return. Essentially, the concept of we want to make money for investors, not from investors, is also a leading concept in the way that we do things. Our fees are a little bit lower because we are coupled with a advisory firm, Burko and Associates, out of New York City. We have a broad reach throughout the United States and multiple projects. We go through 450 projects. We choose carefully the right one. We choose the right developers, and we're able to negotiate. So even after the fees that we collect, the fees that we give our developing partner, our investors tend to do better. Bottom line to them, they tend to do better. I think today we're hovering around, on average, on our equity deals, north of 23%, and that's on the average that we show our investors. So we're fully aware that we're doing better than most, not better than everyone, but definitely better than a lot of others. Alignment of interest. Our money goes in to every deal that we bring. In this particular deal, planning to put a good amount of money, but in every deal that we go into, we have a mandate that our money goes in and takes the exact same risk as each and every one of our investors. The personal approach. At the end of the day, you have access to me. I'm the CEO of the company. You have access to Michael, Corinne, my partner, to Laura, you have us around you. You're not dealing with some sort of click here, push there, send the money, we'll send you the report. And then you're sort of like, you're not dealing with some sort of a computerized, artificial intelligence, who knows what sort of intelligence is behind it. You're dealing with real individuals that've been around the block with collective experiences, I've mentioned, of over 60 years. For me, it makes a difference. I believe that for many of you, it makes a difference. I don't believe in taking money anonymously. Each and every individual, that before they come in with us, they have a conversation with me. They interview me, they interview the company, but I also interview them back to understand what sort of risk levels they have, what sort of approach they have to investing, what sort of approach they have, what sort of aspirations they have. Some individuals are investing, so they're investing for college funds, other for retirement. They want to take trips, all kind of different things. The interaction, for me, it's extremely important, and it's always for the rest of our investors. I'm not going to bore you with all kind of details about more about our background. Of course, this information is available for you. There's a lot that was written about us in the press, in the papers. We're participating in a number of panels, and we do a bunch of different things. We're pretty much public out there. A little bit about our track record in terms of numbers and some of our projects. We're now operating in 12 different submarkets and 7 different states, from Texas to New York City to New Jersey, to Chicago, Miami, Florida, Tampa. We're in 12 different submarkets in 7 different states. Soon to be in Columbus, Ohio, with our cold storage, and so. The company is expanding. We are now at around 3.4 million square feet in project participation, various stages of coming out of the ground to fully stabilized. This is from inception. And our portfolio is just shy of $2 billion in participation. The capital under management on our side alone is $160 million. That brings us to the rest of the end of the presentation. I'm happy if there's any questions. I'm happy to take a couple.
Joe, we do have one question from our audience. Can you please go into a little bit more about Astor's underwriting in relation to inflation and recessions?
Sure. So in relation to inflation, so we're heading into, and we are in an inflationary environment, and it affects everything that we do. It affects our ability to buy material, not to mention that we have shortages in supply. It affects, going to the gas station and so on. One of the best hedges against inflation is always being considered real estate. And the reason is because real estate has a built-in mechanism, especially the commercial real estate, has a built-in mechanism to catch up with increases in cost. And so when you're renting a hotel room per night, you're able to adjust quicker than, let's say, any other form of money pulled in, any other form of capital pulled into any other many sectors. So specifically in the hotel industry, we're able to adjust prices to reflect things like inflation. As far as a recession, my belief is that we are heading into a recession. We are not fully aware of it because the recession conversation tends to happen after the fact, right? Recession by design, or rather by explanation, is 3 consecutive quarters of negative growth, right? So while we're not seeing growth at this moment in time, we are seeing the kind of like the red flags that something is essentially coming. The first thing that we're seeing is an increase in interest rates, and there's been quite a large increase in interest rate in comparison. From 3% environment, we're heading into the 4% environment, and maybe even creeping up from there as well. The second area is, we're seeing that inflation is pushing itself into every sector, and eventually cost of capital, cost of goods is going to create some sort of a slowdown. We're seeing it already in the housing market, which is on fire, and probably one of the reasons, one of the headwinds of why the economy is still moving at the pace that it's moving, but that is slowing. The interest rate will make it slower. We're bringing it out slower. So the general anticipation is that but by design, the way we're underwriting is that things will either stay they are or get worse. So I'm going to take the stand that things will get worse. So what do? Essentially, the sectors will get softer, will get hit a little bit. Prices will curve up and probably start going down to some extent. And so when we're underwriting, and by the way, nobody's anticipating a 2008, 2007 sort of a recession that was like a considered to be one in a hundred years sort of a scenario. But we are going through some sort of a correction. So what do? We take precautionary measures when we're looking into a potential hotel sale in 4 years from today. And I would certainly hope that by the time that the hotel will be ready to be sold, ready obviously built and stabilized, but ready to be sold, will be away from this environment today. So one of the things we works in our favor is that we put a shovel in the ground today. We can go through a recession, but we're only going to be building. The hotel will not be stabilized. So we're looking into the future. Again, recession, 3 consecutive quarters of negative growth. Traditionally, other than 2007, 2008, we're talking about a cycle of about a year, 15 months. And I think we'll be out of the woods and out of that environment by the time we're ready to sell. Secondly, we're taking the account that things will get worse in terms of interest rate. And so for that reason, we're not underwriting a beautiful 6.5 cap. We're not assuming that the hotel will sell for about $190 million or 170 or 100 or 180. We're taking a much more conservative approach to an asset class that is always in high demand. Hotels are always in high demand. They're also volatile, but very much in high demand. We're taking a loan in place. Understand, we're building this hotel to a cap rate of a 13. We're taking a loan in place that we know we have the ability to, if we choose not to sell it, we can always refinance the hotel, replace the amount of capital in place quite in an easy way. And so all those measures together are there to make sure that, if the market is on fire like it is now, we're all making tons of money. And if it's not, we're making good money. I think that the amount that we're anticipating here is great, but still somewhat conservative. Good question. I'm happy to take more questions.
Joe, I do just have one more question from an investor, that if the market does slow down in the 4 years when we are meant to exit, do we have the opportunity to hold on to this investment longer, or do we have to exit 4 years?
We don't have to exit. By mandate, we may elect to stay. If the market is not right, if we're going through some sort of, so somebody wrote something about a pandemic, if the market is not right, if we feel that we're leaving a lot of money on the table, we don't have to exit. So we can keep it until market conditions will improve. One of the things that I've mentioned, I'll say it again, the loan that we have in place, the construction loan and the mezzanine loan, can be replaced with a permanent financing loan. We can replace it eventually when the hotel opens and place a 10-year loan. Certainly wait and take our time, collect nice income, have a nice return. But again, preservation of capital. Somebody also asked what happened to hotels during the pandemic. So it's a tale of two cities. Some of the northeastern cities where closure and COVID mandates were extremely strong. I've seen a much bigger hit to the travel. The hotel industry has suffered much. Some of the other areas have seen somewhat like a short closure period in comparison. And when they've opened up, it sort of flourished. A good example will be Phoenix, Arizona. A good example would be Florida, and specifically Miami. One of the things we look for when we are evaluating a potential partner is to know not just how well he's doing when things are wonderful, but how well or unwell he's doing when things are really tough. HCW, I'm happy to say, have been going on a track record without ever. Doesn't matter which recession, doesn't matter which economic situation they went through, they never returned the keys to the bank, they never lost a project. And we don't expect this to be the first. There's, when you're relying on 45 years, of experience, that's a kind of like the track record where I feel super comfortable with.
Okay, I believe that is that for the questions. I will give a couple of seconds if anybody has any last minute questions before we depart. Beautiful. So I believe that is it. Joe, if anybody does have any, please feel free to reach me after the Zoom and I will get you an answer ASAP.
Well, thank you very much, Laura. Thank you all of you for participating. And again, I want to wish you happy spring holidays, happy Passover, happy Easter, and looking forward to seeing you with us on this deal and on future transactions as well. God bless. Take care.
Thank you, everybody. Thank you for joining. You will receive the package after I end the Zoom, and happy holidays.